One of the ways in which operating managers can significantly enhance the organization's um, competitive edge is by working in a manner so that less cash is required for the organization to be available at any point of time. So what is this? So how much cash should be required by an organization at any point of time? How can one calculate the cash requirement? The metric that we use for this is cash conversion cycle. Cash conversion cycle dictates the number of days, gives you the number of days for which the cash has to be there in the organization due to the operational workflow and the processes that the organization is following. So the way it's done is that an organization, when it is during its operations, it creates inventories. Now it buys raw material and it will create inventory. These inventories are there kept with the organization. Quite a lot of it is being sold, and when it is sold, if it is in credit sales, it creates what we call as receivables, and then the organization has got its suppliers to whom it has to make the payments, so there are payables. So cash conversion cycle dictates that the amount of cash that an organization should have available with it always is the amount of inventories that it has, days of inventory outstanding, the days of sales receivables that is outstanding yet to be collected, minus the days of payables outstanding. So the amount that it has to pay plus the amount that it has to accumulate as inventory and plus provision for the receivables that it will gather over time. Now look at it this way. When we are looking at the inventory and the sales receivables, these two are the amount of cash which is actually stuck up in the organization, and if the organization doesn't have adequate liquidity to be able to manage this number of days, it will find itself in trouble. So how much is days of, so how do you calculate the days of inventory outstanding? So days of inventory outstanding. So earlier we have talked about inventory turns. So days of inventory outstanding is equal to 365 days divided by the inventory turns. Now, so what is inventory turns? If you recall, in one of the earlier video, we had seen that inventory turns is calculated. Inventory turns is equal to cost of goods sold divided by the inventory, which is the number of times the inventory has actually turned over. The higher the inventory turns, the better it is for the organization. And days of inventory outstanding is calculated by 365 divided by inventory turns. Where do you get the COGS? You get the COGS from the profit and loss account. Where do you get the inventory from? You get it from the balance sheet. Now if you look at the other measure, which is days of sales outstanding. Now days of sales outstanding is calculated by, yes, you got it right, sales revenue divided by receivables will give you the turns, receivable turnover ratio, and DSO is equal to 365 by receivable turns. And the third metric that we have here is days of DPO, that is days of payables outstanding. This is typically to the suppliers that you have taken raw material and various other items from. Now this is calculated by cost of goods sold divided by account receivable, which will again give the turns, and 365 divided by the payable turnover ratio will give you the days, the unit in days. Now this is a very simple method to calculate. You need to sit with the profit and loss and the balance sheet of companies, and you'll have it available with you. Try to do this for two sets of organizations. One of them which are capital intensive, like Hindalco, Tata Steel, or the global ones. And the other is try to do it for organizations like Nestle, Dell. Now, as you'll see is that, let's take an example of a company like Hindalco. I tried to calculate this using their 2011 annual report. In this case, the way it worked out for me was that DIO was equal to 121 days. Then we got DSO, which is equal to 20 days, and then DPO was equal to 121 days. So basically CCC is equal to 20 days. So how much cash should the organization have if the CCC is? Now how do you interpret all this data? There's a lot of information here. Yes, they are collecting the sales payment really fast. However, due to high inventory, maybe the inventory of raw material, which is very expensive for this particular industry, the inventory is there for 121 days. One needs to drill down deeper, find out substitutes, alternates, so that the whole amount can be brought lesser, can be reduced. At the third time is the days of payables, DPO. Here this is all about paying the suppliers. So yes, maybe they have got long-term agreements with them, because of which they can have payments which can be made at with a much larger time window, 3 to 4 months period. Now once we look at this, you'll see that for Nestle and Dell, you will come to a figure which is a negative CCC. What does this imply, or what is the implication of this? If the company has a strong brand, now look at it this way. If the company has a strong brand, the company has a great product line, company has excellent operations. If these are there, then the company will land up with a CCC, a cash conversion cycle, which is a very low one, or even low or negative, which means at every stage of the organization, cash is being freed and less cash is required to run the operating cycle of the organization. Now when such a situation happens, the organization is literally in a way having its operations aligned so that it literally mints money. With every cycle of the operation, it is freeing up more and more cash for itself. So if you have a good brand, if you have a good product line, if you have good operations which is managed very well, your cash conversion cycle should be a very small one. And if your cash conversion cycle is a very managed and a small one, you would have less amount of cash deployment required, and your operating cycle would keep on constantly freeing up more and more cash. So that's one way to look at the cash conversion cycle, monitor that, increase that over time, reduce the CCC over time, and increase the cash and thereby reduce the cash requirement that your organization has. A definite thing which is in the control of managers and leads to significant improvement for an organization.